lessons from my most recent business acquisition. In this video, I wanted to go over some of the key lessons that I learnt with this most recent business acquisition, which I completed last week, maybe on Tuesday. Yeah, it was on Tuesday last week. And it was a fantastic experience with this particular business acquisition because I was finally dealing with people who understood business and understood investments, which was a breath of fresh air. So I've got my trusted notebook because I wanted to write down a bunch of lessons. So I'm going to be using my notes. I went 3 pages of notes with the lessons that I learned from this particular acquisition. And I hope it's massive value for you so you can think about business acquisitions as a business owner and how you can grow your business and what you might need to be thinking about when you are going to do your next business acquisition. So let's start off with some of the basics. Why or what are the circumstances which led to me becoming interested in this business acquisition? So firstly, this particular business acquisition was introduced to me via a business broker. Of course, business brokers, they get a massive negative even I sometimes speak that you don't need business brokers to buy or sell a business. But if you find a good business broker, and sometimes you find a good business through a business broker, it doesn't matter whether you've gone through it via a business broker or whether you found it yourself through cold outreach, letters, or all of these other ways that you can actually find businesses through networks and so on. You need to go ahead and go for that particular business acquisition because it's the business which counts, not the method in which it came to you, right? And of course the deal and so on and so on. So it was introduced by a broker. It's a £1 million turnover business. It's got high profit margins of 20%. And that is what, initially you need to have a look at your minimum criteria that doesn't meet your revenue target and doesn't meet your profitability target. And this one, of course, did. Now, in addition to that, it's a long established business. The business has been around for around about 30 years, maybe a little bit longer than that. I think it was coming up to 30 years now. So it's been around for a long time. It's gone past that stage where they say the first year of business is where you have the most failures, 5 years and 10 years and so on. So this has stood the test of time. And it has a long-standing management team, very, very important. So especially when you're a business owner and you're looking to expand your business, you need to see that does it have a management team. Now, this might not be important for you if you're a business owner. You might want to install your current management team. But what this management team shows you is that the business can be run independent of the owner. So the business was run independent of the owner. The owner didn't do anything in the business at all for 5 years, with the exception of authorizing some high value payments in which normally a CFO would do in my business, for example. So that's the only thing that this particular business owner was doing. Otherwise, not involved in sales, not involved in management, not involved in customer relationships, not involved in customer service or general management, nothing at all. So that's absolutely fantastic because I don't work in these businesses. So I want to make sure that there's an established management team in the businesses that I am buying. And in addition to that, there was clean and quality accounts. So clean and quality accounts really massively helps you as a business buyer and a business seller as well, because of course you're able to read financials which actually make sense in the real world. You're able to read lines and you can understand what that cost is, and you don't have to guess as to what's in that particular line or what is it about. So having good clean financials, and not only clean financials, this business had clean financials for a 7-year period, which shows that they were doing the right thing as per, in this country is HMRC, in the US it might be IRS, of course. So they're doing the right things, and the clean financials just give you confidence that the business is being run in a professional manner. So that's really, really important. So, all of the above has made me interested in this particular business as an acquisition prospect, that it's run without the owner. It's got good clean financials for a long period of time. It's got good turnover and it's got a good profit margin. So that's it ticks a lot of my minimum criteria boxes. I talk about non-negotiables and nice to haves. This of course ticks a lot of the non-negotiables and also some of the nice to haves. So then I went and I pursued this business acquisition a little bit further. The owners also, as I mentioned before, are business owners or they're business people. So they understand, and they're investors too. So they understood the concept of return on investment and return on equity. So when I am making my case for a particular thing, whether it's the price or a particular clause that we're negotiating, they understood where I was coming from a acquirer's perspective, from an investor's perspective, and they were able to appreciate that. And the best thing is that they knew exactly what they wanted from the business sale itself. So they knew what they wanted, but most importantly, they were consistent in what they wanted as well. What you find sometimes with business sellers who don't understand the process or not savvy business people or investors is that they might say something that they want something on day one, but then on day 5 they're moving the goalposts. And the problem is that you can never deal with that kind of person, because one day you might agree something and the next day it's completely separate. Now, we had occasions of this in this deal, and we have occasions of that in every single deal. But the main principles, the main criteria, they knew exactly what they want and they didn't move that goalpost. So we knew exactly what we needed to do to get them to be happy, and then there were other parts which we were able to negotiate and put into our favor. So that's really important when you're dealing with a business owner who understands business and investments and also is consistent in what they want and they know what they want. It helps you in negotiation. Now, they had clean financials, and what I was able to do with this is to really read through the history of the business just through the accounts itself. Warren Buffett, he talks about understanding the entire business just through annual reports, because I really got this from Warren Buffett himself. Is that some years ago I was watching one of his annual meetings, which are available online, of course, and you should watch them. They're very, very good sources of information on how you need to think about business acquisitions and business investments. So he said is that I just have to read the annual reports and I should be able to understand everything about the business. Now, the slightly different thing with Warren Buffett is that normally he's investing in public companies. So public companies, what they do is that they have to produce the statutory reports which are required by them from the particular authorities, but also they add management information into those reports. Now, the private businesses that we deal with don't have that kind of information, but the financials do really tell a story. And especially in this case where we had 7 years worth of clean financials, we were able to look at so much from the accounts in terms of where it was 7 years ago and the journey that it's taken over the last 7 years, and where it's gone from strength to strength, the employee numbers, what they're spending their money on, where they, for example, some investments they put money in and then they obviously didn't have a great outcome, and the other areas where they did have a great outcome. You can read all of that from the financial reports itself, from the financial accounts. And I had one meeting with the seller which filled in the gaps of where the accounts wouldn't tell me that story from a private business perspective. So per public companies, you would have all of that in the annual reports. In these private companies, they're not in the financial accounts. So I had one meeting with the seller. Now, what happened is that just by reading the accounts and having that one meeting with the seller, I didn't even visit the business. I didn't do anything. I done my due diligence, desktop due diligence, which is checking online and everything about the business itself, looking at that perspective. And then I made an offer. And I made an offer, of course, this is not a video about how to make offers and so on. However, I made an offer and we went through the negotiation and everything. And I got the business offer accepted at 2x, 2 times EBITDA. Now, for those of you who understand, 2 times EBITDA is a very good multiple to get a business. It's not a very good multiple, it's a good multiple to get a business. A very good multiple would be something like 1 or 1.5, or even something under 2 would be a very good multiple. Now, we got this business accepted at 2 times EBITDA, and in business and investment perspective, if you're looking at it, what I'm looking at is that I will be able to get all of my money back of what we invested to buy the business in 2 years, as long as it continues to trade at the same level that it's currently trading at. And that's fantastic. Now, of course, there's DSCR and so on that we have to look at, but in a very easy to understand format, 2x multiples, meaning I will get my money back in 2 years of the investment. So that was a really good deal that we got, and it was easy to deal with them, again, because they're investors. They knew about negotiation. They knew what I'm looking for, and they appreciated that. So negotiation was a little bit back and forth, and then we got the deal accepted. Now, in addition to getting the deal accepted at 2x of EBITDA, it was 1x on day one. So 1 year's worth of profit we paid on day one, and 1 year's worth of profit, so 1x of the EBITDA, was paid over time through seller's finance. So essentially, even though we got it at 2x multiple of EBITDA, we're only paying 1x, so 1 year worth of profit on day one, which means our risk then gets a little bit lower because we're paying the rest of it through seller's finance. So even though it was really easy to get the negotiation and the deal accepted with the seller, there were a few problems with this particular business acquisition, and the problems were actually more from the lawyer themselves. And what you find is that if you don't have a lawyer, or you're not dealing with lawyers who understand M&A in the same way that your lawyers do, because of course, if you're doing business acquisitions, you want to get a team who really understands M&A, then they can create unnecessary problems which weren't there in the first place. So there were a few problems with the lawyer, but the biggest problem, or the main problem that we found, was with regards to something called security of tenure. Now in the UK, what that means is that if you have security of tenure, then it gives the tenant, it gives the business the automatic right to renew, or at least they don't have to get a renewal when the lease ends. So this particular lease, the lease was 10 years, and the seller was the freeholder themselves. So they were selling it either freehold or leasehold business. We decided to go for leasehold because that's what we do, with the first right of refusal, which is one of the key things that always get put in if, for example, the seller is the freeholder as well, but that's a different story. In any case, the lawyer was advising their client that they shouldn't provide security of tenure clause in the contract. So, this is a risk. This is a risk. This means that, for example, in 10 years' time, when the lease ends, we have to get a renewal. Otherwise, we can't stay in the property. Now, how much of a risk is that? It basically means that if, for example, the freeholder decided that they wanted to knock the building down and maybe build a block of flats or something like that, or repurpose the building, they can do that. They can kick us out. So what I had to think about, right, what is the worst case scenario? So even though, for example, you have these curveballs which are thrown at you, you need to have your entrepreneur's hat on. It's really, really important that you look at every single thing in an acquisition from both an investor's perspective, a risk perspective, but also ultimately an entrepreneur's perspective. So when I look at this problem of security of tenure and them not granting it, then and it was a deal breaker for them essentially. So I'm looking at this and thinking, right, what is the actual risk? The risk is that we will make 2 million to 2.5 million from this business over the 10-year period, and then we have to shut the business down. Now, we are getting this for way less than that, which means our return on investment, our return on equity on this particular investment will be that we will make 10x our money, or not 10x, 5x. Yeah, we'll make 5x on our money over the course of the life of the lease. And worst case scenario, that's the worst case scenario. So we make 2.5 million, 2 million to 2.5 million over the course of the lease, and then we have to shut the business down. Now, for me, of getting such a high quality business, because not only is this producing good revenue and good profits, it's serving the exact type of customer that our current businesses serve as well, premium customers. So when we've got that kind of business opportunity in front of us and we've got a good deal accepted, I went ahead and I continued with the particular business acquisition, and we've got first right of refusal as well, which means that if the seller wants to sell the property, they have to give us the opportunity to buy it first. And then only if we say no, that they will go and sell it to someone else. That also means that, for example, if they got an offer, which is an actual offer in writing, offer in principle from a particular potential buyer, then they would say, right, they have to come to us first and say, right, do you want to buy it on these terms? If not, we'll continue and sell it to someone else. So we've got that, sort of, it's not really security, but we had that clause as well, which gives us some security that we could possibly buy the freehold if required. So it's not too much of a risk in my perspective, and I went ahead and I went and signed on that. So that was the main risk of the transaction, and that was again caused by the lawyer themselves. And the last thing, which was very, very important with this particular business acquisition, I mean, we do this with a lot of our business acquisitions, but with this one in particular, we were because the owner wasn't doing anything in the business for 5 years, we wanted to meet the management team. So we were able to meet the management team twice, just the management team twice before the particular business acquisition went through. And also we were able to meet the entire team for once. So essentially we had 3 different meetings with the management team and one meeting with the entire team, which gave us comfort that they knew what was going on and they knew who we were. Don't forget, whenever a team, a business, staff members of a business are going through an acquisition, they're frightened for their job. They're worried about their job. They're like, are we going to get fired? What's going to happen to our livelihood? are the new owners going to keep us? So in this case, of course, we wanted to keep every single person, and they knew that. Then they became comfortable. We got acquainted with the management team. I got different people from my company, from my business, because we've got a wider business, of course, to go and meet the people, and that gave them comfort. You know, it's good to send peer-to-peer people who are peers of them. So I sent their peers from my business over to the new business to take a look at so they can meet each other and they can have that comfort. Because there's one thing, them meeting the ultimate owner investor, but there's another thing, meeting the people who they will be interacting with more than anyone else. And that gave them real comfort. So this was a great opportunity for us, and we went ahead with it and we completed the deal. From start to finish, it took us about 4 months. Now, we first found out about this deal around about 8-9 months ago, and we weren't too serious about it. But as we learned more and more about the business from, the broker's obviously doing his job by selling the opportunity to us. And the more we learned about the business, the more interested we got. So when we actually got serious about it, it was about 4 months. So from actual, being serious about the acquisition to closing the deal, it was about 4 months to close the transaction. And the deal was completed with minimal frustration from both sides. A really great experience. And of course, we understand, or I understand, and I coach my clients on this, is that if you have a smooth process, you really understand the business acquisition process, the business sale process, and you're able to guide the seller to the acquisition themselves, the seller will appreciate it. One thing that happened after this particular acquisition went through is that the seller actually picked up the phone, and they said that it was an absolute pleasure selling the business to us, in the sense that we supported them in the way that they never thought a buyer would support the seller. So we supported them in the business acquisition, and that gives us confidence, and just think about what kind of opportunity that could potentially bring us in the future. Is that if they know that someone is selling a business, then they're going to recommend us as potential buyers. Obviously they know what our minimum criteria is, so they will recommend us, and then we will get first opportunity on that before it goes out to the wider market. So these are some of the lessons. Essentially, it was a great business. It was a value acquisition. I'm going to talk about value acquisition on my channel, so go and watch some videos with regards to value acquisitions there. Great business, great management team. Obviously, no or minimum involvement from the owner, almost no involvement from the owner. Clean financials, able to meet the management team, good long-standing business with good turnover, good profitability. So that was a perfect acquisition. And if that's the type of acquisitions that you need to look for. So of course, if you want to find out more about how you can grow your business via acquisitions, there's a link in the description which shows the 7 steps on how to complete your first acquisition. So download that and learn the steps, and go and do an acquisition, and of course watch more videos on my channel.